Section 1.1 to 2.3 Understanding Active Investing, Strategies for Beating the Market. 1.1 Definition and Principles of Active Investing. Active investing and passive investing are two different investment strategies with distinct approaches and objectives. Here's how they differ. Active investing. Active investing involves actively managing an investment portfolio by making frequent buying and selling decisions with the goal of outperforming the market or a specific benchmark. Here are some key characteristics of active investing: research and analysis. Active investors conduct in-depth research, analyze financial statements, study market trends, and use various valuation methods to identify undervalued or overvalued securities. Frequent trading. Active investors buy and sell securities more frequently to take advantage of short-term price fluctuations, market inefficiencies, or perceived opportunities. Individual security selection. Active investors focus on selecting specific stocks, bonds, or other securities that they believe will outperform the market or generate higher returns. Higher costs. Active investing typically incurs higher costs due to transaction fees, management fees, and potential taxes associated. With frequent trading. Active portfolio management. Active investors actively monitor their portfolios, making adjustments and reallocating assets based on market conditions, performance evaluations, and changes in investment strategy. Passive investing. Passive investing, also known as index investing or buy and hold investing, aims to replicate the performance of a specific market index rather than outperforming it. The key features of passive investing include: index-based approach. Passive investors construct their portfolios to mimic the performance of a specific market index, such as the S&P 500 or a bond index. This is done through investing in a diversified set of securities that mirror the index's composition. Minimal trading. Passive investing involves minimal trading activity, as the investor aims to hold the investments for the long term and maintain the same asset allocation as the underlying index. Low costs. Passive investing generally incurs lower costs compared to active investing since it involves fewer trades and typically utilizes low-cost index funds or exchange-traded funds, ETFs, that have lower management fees, market returns, rather than trying to beat the market. Passive investors seek to achieve market returns over the long term by holding a diversified portfolio that reflects the composition of the chosen index. Reduced time commitment. Passive investing requires less time and effort as it does not involve continuous research, analysis, and active portfolio management. It's worth noting that both active and passive investing have their respective advantages and drawbacks. Active investing offers the potential for higher returns but requires skill, time, and effort, while passive investing provides broad market exposure with lower costs and reduced time commitment. The choice between the two depends on an individual's investment goals, risk tolerance, time horizon, and investment expertise. Some investors may even opt for a combination of both strategies, blending active and passive elements in their portfolio management approach. The goals and objectives of active investors can vary depending on their investment philosophy, risk appetite, and time horizon. Here are some common goals and objectives pursued by active investors. Outperforming the market. Active investors aim to achieve returns that exceed the overall market or a specific benchmark index. They believe that by actively managing their portfolios and making informed investment decisions, they can identify mispriced securities, take advantage of market inefficiencies, and generate superior returns. Capital growth. Active investors often prioritize capital appreciation and seek to grow their investment portfolios over time. They aim to identify undervalued stocks or other investment opportunities that have the potential for significant price appreciation. Beating peer investors. Active investors may compare their performance against their peers or professional fund managers. They strive to outperform other investors or actively managed funds to demonstrate superior investment skill and achieve higher returns. Risk management. Active investors may have a focus on risk management and seek to mitigate potential losses. They employ strategies such as diversification, asset allocation, and active risk monitoring to minimize downside risk and protect their investment capital. Flexibility and adaptability. Active investors often have the advantage of being able to react quickly to changing market conditions or economic factors. They may adjust their portfolios, reallocate assets, or adopt new investment strategies based on their analysis of market trends, emerging opportunities, or potential risks. Income generation. some active investors prioritize generating income from their investments. They may seek out dividend-paying stocks, fixed-income securities, or other income-generating assets to provide a steady stream of cash flow, personal involvement and engagement. Active investors may find enjoyment and fulfillment in actively participating in the investment process. They enjoy conducting research, analyzing financial data, and staying updated on market trends. They may also engage in shareholder activism, attending shareholder meetings, and actively influencing corporate governance decisions. It's important to note that the goals and objectives of active investors can vary significantly depending on individual preferences, investment styles, and market conditions. While some active investors may aim for aggressive growth and high-risk strategies, others may prioritize capital preservation and lower-risk approaches. Each investor may have a unique combination of goals and objectives based on their investment objectives and personal circumstances. 1.2 Active versus passive investing debate. Active investing has both advantages and disadvantages. Here's an analysis of the pros and cons of active investing. Pros of active investing: potential for higher returns. Active investing aims to outperform the market or a specific benchmark, which provides the potential for higher returns. Skilled active investors may be able to identify undervalued securities, take advantage of market inefficiencies, and generate superior performance. Flexibility and adaptability. Active investors have the flexibility to adjust their portfolios, reallocate assets, and adopt new strategies based on changing market conditions or emerging opportunities. This agility allows them to capitalize on market trends and potentially generate higher returns. Active risk management. Active investors can actively manage and monitor their investment portfolios, allowing them to respond to potential risks or downside threats. They can employ risk management strategies such as diversification, asset allocation, and stop-loss orders to mitigate losses. Potential for skill demonstration. Active investing provides an opportunity for skilled investors to showcase their investment expertise and differentiate themselves from passive investors or benchmark indices. Outperforming the market consistently can demonstrate skill and potentially attract new clients or professional opportunities. Cons of active investing: higher costs. Active investing typically incurs higher costs compared to passive investing. Frequent trading, research expenses, and management fees associated with active investment strategies can erode investment returns over time. These costs can be significant, particularly for individual investors or actively managed funds. Market inefficiency challenges. While active investing aims to exploit market inefficiencies, it can be challenging to consistently identify mispriced securities or gain a sustainable competitive advantage over other market participants. It requires extensive research, analysis, and continuous monitoring, which may not always result in outperformance. Emotional bias and behavioral pitfalls. Active investing can be subject to emotional bias and behavioral pitfalls, such as overconfidence, herd mentality, and cognitive biases. Investors may make impulsive or irrational decisions based on short-term market movements, leading to suboptimal outcomes. Time and effort requirement. Active investing demands significant time, effort, and expertise. It involves continuous research, analysis, and monitoring of market trends, financial statements, and news. This level of involvement may not be suitable for all investors, particularly those with limited time or knowledge of the financial markets. Underperformance risk. Active investing carries the risk of underperforming the market or benchmark indices. Studies have shown that a significant percentage of active fund managers fail to outperform their respective benchmarks consistently over the long term. This underperformance risk can lead to lower returns compared to passive investing alternatives. It's important to note that the success of active investing depends on the skills, experience, and capabilities of individual investors or fund managers. While active investing offers the potential for higher returns and active risk management, it also comes with higher costs, challenges in consistently beating the market, and the potential for underperformance. Investors considering active investing should carefully assess their goals, risk tolerance, and time commitment before deciding on this strategy. The role of active management in a portfolio depends on various factors, including an investor's goals, risk tolerance, time horizon, and investment philosophy. Here are some key considerations when assessing the role of active management: potential for outperformance. active management aims to generate returns that exceed the market or a specific benchmark. If an investor believes in the potential for skilled active managers to identify mispriced securities or take advantage of market inefficiencies, they may allocate a portion of their portfolio to active management with the expectation of achieving higher returns. Diversification. Active management can provide an opportunity for diversification beyond the broad market indices. Skilled active managers may have expertise in specific sectors, regions, or investment strategies that can complement a diversified portfolio and potentially reduce risk through non-correlated assets. Risk management. Active management allows for active risk management techniques, such as asset allocation adjustments, sector rotation, or defensive positioning during market downturns. Active managers can respond to changing market conditions, potentially reducing downside risk or limiting losses. Personal involvement and satisfaction. Some investors may enjoy actively participating in the investment process. Conducting research, analyzing financial data, and making investment decisions. Active management provides an opportunity for investors to engage with their portfolios, align their investments with personal values, and feel a sense of control or satisfaction. Investment expertise. Investors who lack the time, knowledge, or confidence to make investment decisions may choose active management to leverage the expertise of professional fund managers. Skilled active managers may have access to research, resources, and insights that individual investors may not have, potentially adding value to the portfolio. However, it's important to consider the following limitations and challenges associated with active management. Higher costs. Active management typically involves higher fees and expenses compared to passive investing. Transaction costs, management fees, and other expenses can eat into investment returns, potentially impacting long-term performance. Performance consistency. Consistently outperforming the market or benchmarks is challenging for active managers. Studies have shown that a significant percentage of active managers fail to outperform their benchmarks consistently over the long term. Identifying skilled managers who can deliver consistent outperformance is difficult. Behavioral biases. Active managers, like all investors, can be subject to behavioral biases and emotional decision-making. Overconfidence, herd mentality, and other cognitive biases can impact investment decisions, potentially leading to suboptimal outcomes. Market efficiency. Efficient markets theory suggests that stock prices reflect all available information, making it difficult to consistently identify mispriced securities or gain an informational advantage. Active managers face the challenge of competing with other market participants and overcoming the efficiency of the markets. Time commitment. Active management requires significant time and effort. Investors need to stay updated on market trends, economic indicators, and company-specific news. This level of involvement may not be suitable for all investors who prefer a more hands-off or time-efficient approach. In summary, the role of active management in a portfolio depends on an investor's specific circumstances, preferences, and beliefs about market inefficiencies. Active management can potentially add value through potential outperformance, diversification, and active risk management, but it also comes with higher costs and challenges in consistently beating the market. It's important for investors to carefully assess their goals, risk tolerance, and available resources before determining the appropriate role of active management in their portfolios. Section 2, Fundamental Analysis for Active Investing. 2.1 Introduction to Fundamental Analysis. Fundamental analysis is a method used to evaluate the intrinsic value of a security, such as a stock or bond, by examining the underlying factors that can influence its price. Here are some key principles of fundamental analysis. Financial statements. Fundamental analysis begins with studying a company's financial statements, including the income statement, balance sheet, and cash flow statement. These statements provide insights into the company's revenues, expenses, assets, liabilities, and cash flow, which are essential for evaluating its financial health and performance. Business and industry analysis. Fundamental analysis involves assessing the company's business model, industry dynamics, competitive positioning, and growth prospects. Understanding the company's products or services, market share, competitive advantages, and potential risks is crucial in determining its long-term sustainability and growth potential. Earnings and revenue analysis. Fundamental analysts examine a company's earnings and revenue trends over time. They analyze factors that impact profitability, such as sales growth, profit margins, operating expenses, and earnings per share (EPS). Comparisons to industry peers and historical performance help assess the company's financial strength and its ability to generate sustainable earnings. Valuation methods. Fundamental analysis involves using various valuation methods to estimate the intrinsic value of a security. Common valuation techniques include price-to-earnings ratio, P/E ratio, price-to-sales ratio, P/S ratio, discounted cash flow, DCF, analysis, and comparable company analysis. These methods help determine whether a security is overvalued, undervalued, or fairly priced. Management evaluation. Fundamental analysis considers the competence and integrity of a company's management team. Evaluating the track record, experience, strategic decisions, and corporate governance practices of management can provide insights into the company's ability to execute its business plans effectively. Macroeconomic analysis. Fundamental analysts assess macroeconomic factors, such as interest rates, inflation rates, GDP growth, and government policies, that can impact a company's performance and the overall market. Understanding the broader economic environment helps engaging the potential risks and opportunities for a company's operations. Qualitative factors. In addition to quantitative analysis, fundamental analysis considers qualitative factors that may affect a company's prospects. These factors include brand reputation, intellectual property, regulatory environment, technological advancements, and social and environmental factors. Qualitative analysis helps capture the broader context in which a company operates. Long-term perspective. Fundamental analysis takes a long-term view of investments, focusing on the underlying value of a security rather than short-term price fluctuations. It seeks to identify securities that are undervalued relative to their intrinsic worth, with the expectation that market prices will eventually align with the fundamental value. It's important to note that fundamental analysis requires a combination of financial knowledge, industry understanding, and critical thinking skills. Analysts use these principles to form an opinion on the attractiveness of a security for investment purposes. However, it's crucial to consider that fundamental analysis is not foolproof and involves inherent uncertainties and subjectivity. Therefore, investors often combine fundamental analysis with other tools and approaches to make well-informed investment decisions. Analyzing financial statements, ratios, and valuation metrics is an integral part of fundamental analysis. These tools provide insights into a company's financial health, performance, and valuation. Here's a breakdown of how they are used. Financial statements analysis. Financial statements, including the income statement, balance sheet, and cash flow statement, provide a snapshot of a company's financial performance and position. Analysts examine these statements to assess the following: revenue and profitability, revenue trends, gross profit margin, operating income, and net profit margin help evaluate a company's ability to generate profits, liquidity and solvency, current assets, current liabilities, and debt levels indicate a company's ability to meet short-term obligations and manage long-term debt. Asset efficiency. Efficiency ratios such as inventory turnover, accounts receivable turnover, and accounts payable turnover measure how effectively a company utilizes its assets and manages its working capital. Cash flow from operations, investing activities, and financing activities provide insights into a company's cash generation, capital expenditures, and funding sources. Financial ratios. Financial ratios are calculated using data from financial statements to assess a company's performance, profitability, efficiency, liquidity, and solvency. Common financial ratios include liquidity ratios. Current ratio and quick ratio measure a company's ability to meet short-term obligations with its current assets. Profitability ratios. Gross profit margin, operating profit margin, and net profit margin assess a company's profitability relative to its revenues and costs. Return ratios, return on assets, ROA, and return on equity, ROE, measure how effectively a company utilizes its assets and equity to generate returns. Debt ratios, debt to equity ratio, interest coverage ratio, and debt to assets ratio evaluate a company's leverage and its ability to service debt obligations. Efficiency ratios, inventory turnover, receivables turnover, and payables turnover measure how efficiently a company manages its assets and collects payments. Valuation metrics. Valuation metrics are used to estimate the intrinsic value of a security, such as a stock or a company as a whole. Some commonly used valuation metrics include price-to-earnings ratio, P/E ratio. It compares the market price of a stock to its earnings per share, providing an indication of how much investors are willing to pay for each dollar of earnings. Price-to-sales ratio, P/S ratio. It relates a company's market capitalization to its total revenue, indicating the valuation based on sales generated. Price-to-book ratio, P/B ratio. It compares a company's market price to its book value per share, reflecting the value that investors assign to a company's net assets. Dividend yield. It measures the annual dividend payment relative to the stock's market price, providing insights into the income generated by an investment. Discounted cash flow, DCF, analysis. It estimates the present value of a company's future cash flows, considering the time value of money, to determine its intrinsic value. These financial statements analysis, ratios, and valuation metrics are tools used by analysts and investors to gain insights into a company's financial performance, position, and valuation. However, it's important to consider them in conjunction with other factors such as industry trends, competitive analysis, and qualitative aspects to make well-informed investment decisions. 2.2 Identifying value stocks. Value investing is an investment approach that involves identifying undervalued securities and investing in them with the expectation that their intrinsic value will be recognized by the market over time. Here are some key principles and strategies associated with value investing. Intrinsic value assessment. Value investors focus on assessing the intrinsic value of a security, which represents its true worth based on fundamental factors. They analyze financial statements, ratios, and other quantitative and qualitative factors to estimate the intrinsic value of a company or its assets. Margin of safety. Value investors seek a margin of safety when investing, aiming to buy securities at a price significantly below their estimated intrinsic value. This provides a cushion against potential errors in valuation and market fluctuations, reducing the risk of permanent capital loss. Long-term orientation. Value investing typically takes a long-term approach, as it may take time for the market to recognize the underlying value of undervalued securities. Value investors are patient and willing to hold investments for an extended period, waiting for the market to align with their estimated intrinsic value. Contrarian thinking. Value investors often adopt a contrarian mindset, going against prevailing market sentiments and trends. They look for opportunities where market prices diverge from the underlying fundamentals of a security, seeking investments that are unloved, neglected, or out of favor. Fundamental analysis. Value investing relies heavily on fundamental analysis to evaluate a company's financial health, performance, and competitive position. It involves analyzing financial statements, ratios, industry dynamics, management quality, and other relevant factors to identify undervalued securities. Buy and hold strategy. Value investors tend to follow a buy and hold strategy, as they believe in the long-term potential of their investments. They avoid frequent trading and focus on the merits of the investment rather than short-term price fluctuations. Patience and discipline. Value investing requires discipline and patience. Value investors wait for favorable investment opportunities, conducting thorough research and analysis before making investment decisions. They remain committed to their investment thesis, even during periods of market volatility or when the market's recognition of value takes time. Emphasis on quality. While value investors seek undervalued securities, they typically emphasize investing in high-quality companies with solid financials, competitive advantages, and sustainable business models. They look for companies with strong management teams, solid track records, and favorable long-term prospects. Risk management. Value investors focus on risk management and aim to avoid permanent capital loss. They conduct extensive due diligence and risk assessment to identify potential risks and evaluate the downside protection of their investments. Margin of safety exit. Value investors may consider selling a security when its market price approaches or exceeds its estimated intrinsic value, reducing the margin of safety. They look for other undervalued opportunities to allocate their capital effectively. It's important to note that value investing is a long-standing investment philosophy, popularized by legendary investors like Benjamin Graham and Warren Buffett. However, successful implementation of value investing requires a deep understanding of financial analysis, patience, discipline, and a contrarian mindset. Investors should conduct their own research, adapt these principles to their own circumstances, and seek professional advice when needed. Evaluating undervalued stocks using fundamental analysis involves a thorough assessment of a company's financials, industry dynamics, and qualitative factors to determine whether the stock is trading below its intrinsic value. Here are some steps to consider when evaluating undervalued stocks. Identify potential candidates. Begin by screening for stocks that have the potential to be undervalued. This can be done by looking for companies with low price-to-earnings (P/E) ratios, low price-to-book (P/B) ratios, or low price-to-sales (P/S) ratios compared to their industry peers or historical averages. You can use financial websites, stock screeners, or professional research tools to assist in this process. Analyze financial statements. Dive into the company's financial statements, including the income statement, balance sheet, and cash flow statement. Look for indicators of financial strength, such as consistent revenue growth, healthy profit margins, and strong cash flow generation. Assess the company's debt levels, liquidity position, and ability to meet its financial obligations. Assess valuation metrics. Calculate valuation metrics, such as P/E ratio, P/B ratio, or P/S ratio, for the company in question. Compare these ratios to industry averages, historical levels, and the company's peers to determine if the stock is trading at a discount relative to its true value. Consider the company's growth prospects and potential catalysts that could drive future value. Evaluate business and industry factors. Assess the company's competitive position within its industry. Analyze its market share, competitive advantages, barriers to entry, and growth potential. Evaluate industry trends, technological advancements, and regulatory factors that could impact the company's performance. Look for indications that the market may have undervalued the company's prospects. Conduct qualitative analysis. Consider qualitative factors that may influence the company's value. Evaluate the quality of management, their track record, and their alignment with shareholders' interests. Assess the company's brand reputation, intellectual property, and any other unique assets or advantages that could contribute to its value. Consider any potential risks or uncertainties that may affect the company's future prospects. Consider risk factors. Evaluate potential risks and uncertainties associated with the company and its industry. Assess factors such as market volatility, competition, regulatory changes, and technological disruptions. Consider the company's ability to adapt to changing market conditions and potential downside risks. Compare to intrinsic value. Estimate the intrinsic value of the stock using valuation methods such as discounted cash flow (DCF) analysis or comparable company analysis. Compare this intrinsic value estimate to the current market price. If the intrinsic value is significantly higher than the market price, it may indicate that the stock is undervalued. Monitor catalysts. Identify potential catalysts that could drive the stock's value realization. These could include upcoming product launches, anticipated industry developments, or management initiatives that may positively impact the company's financial performance or market sentiment. Remember that evaluating undervalued stocks using fundamental analysis requires a combination of financial knowledge, industry understanding, and critical thinking. It's important to conduct thorough research, stay updated on company news and developments, and reassess your analysis periodically as new information becomes available. Additionally, it's advisable to consider diversification and consult with a financial advisor or investment professional to ensure your investment decisions align with your risk tolerance and investment goals. 2.3 Growth Investing Strategies. Growth investing is an investment strategy that focuses on investing in companies that have the potential for significant earnings growth and capital appreciation in the future. Growth investors seek out companies with strong growth prospects, often characterized by above-average revenue and earnings growth rates. Here are some key drivers and characteristics of growth investing. Revenue and earnings growth. The primary driver of growth investing is the expectation of robust revenue and earnings growth. Growth investors look for companies that demonstrate a track record of strong growth or are expected to experience accelerated growth in the future. These companies often operate in expanding industries or have innovative products or services that can capture market share, market leadership, and competitive advantage. Growth investors seek companies that have a competitive advantage, such as a strong brand, intellectual property, proprietary technology, or unique market positioning. These factors can help companies sustain their growth rates and fend off competition. Innovation and disruption. Growth investing often focuses on companies that are at the forefront of innovation and disruptive technologies. These companies may introduce new products or services that have the potential to revolutionize an industry or create new markets. Growth investors look for companies that can capitalize on these innovative trends, scalability, and operating leverage. Growth companies often have business models that can scale rapidly without proportional increases in costs. This scalability can lead to higher profit margins and increased earnings growth as revenue expands. Growth investors assess a company's ability to leverage its existing infrastructure and customer base to drive profitable growth. Strong financials. While growth companies are expected to invest heavily in their growth initiatives, they should also exhibit solid financial fundamentals. Growth investors analyze a company's financial statements to assess its liquidity, profitability, and cash flow generation. They look for signs of sustainable growth and the ability to fund future expansion. Long-term investment horizon. Growth investing typically has a long-term investment horizon. Growth investors understand that it may take time for companies to realize their full growth potential and for the market to recognize their value. They are willing to hold investments for an extended period, allowing the compounding effect of growth to drive returns. Valuation considerations. While growth investors prioritize growth potential, they also evaluate the valuation of growth stocks. High-growth companies may trade at premium valuations, but growth investors consider the balance between growth prospects and the price they are paying for those prospects. They assess valuation metrics such as price-to-earnings, P/E ratio, price-to-sales, P/S ratio, or other valuation multiples to gauge the attractiveness of an investment. Risk management. Growth investing involves risks, including the potential for high volatility in market sentiment shifts. Growth investors carefully manage risk by diversifying their portfolios and conducting thorough research. They analyze potential risks and uncertainties, such as competitive threats, industry disruption, and regulatory changes, to understand the potential impact on a growth company's future growth prospects. It's important to note that growth investing involves higher risks compared to other investment strategies. The success of growth investing relies heavily on accurate assessments of a company's growth potential and the ability to identify sustainable growth drivers. Investors interested in growth investing should have a high tolerance for risk and be prepared for potential fluctuations in stock prices. Conducting thorough research, staying updated on industry trends, and seeking professional advice can help in making well-informed investment decisions. Identifying growth stocks using fundamental analysis involves assessing a company's financial health, performance, and growth prospects to determine if it has the potential for significant earnings growth in the future. Here are some key steps to identify growth stocks using fundamental analysis: revenue and earnings growth. Look for companies that have a track record of strong revenue and earnings growth. Review historical financial statements to identify consistent growth trends. Consider companies that have demonstrated the ability to increase sales and earnings at an above-average rate compared to their industry peers. Industry and market trends. Evaluate the industry dynamics and market trends to identify sectors that are experiencing growth. Look for industries with favorable macroeconomic conditions, technological advancements, or changing consumer preferences that can drive future growth. Focus on companies that are well-positioned to benefit from these trends. Sustainable competitive advantage. Assess a company's competitive position and its ability to maintain a sustainable competitive advantage. Look for factors such as strong brand recognition, intellectual property, unique technology, or a dominant market share that can provide a barrier to entry for competitors and support long-term growth. Financial strength. Review the company's financial statements, including the income statement, balance sheet, and cash flow statement. Assess the company's liquidity, profitability, and cash flow generation. Look for signs of strong financial health, such as increasing profit margins, efficient use of capital, and positive operating cash flow. Growth drivers. Identify the key drivers of the company's growth. This could include factors such as new product launches, market expansion, international growth opportunities, or acquisitions. Evaluate the company's strategy and execution plan for capitalizing on these growth drivers. Research and development, R&D, and innovation. consider the company's investment in research and development activities. Look for companies that allocate a significant portion of their resources to innovation and product development. Evaluate the company's ability to bring new and innovative products or services to the market, which can be a catalyst for future growth. Management quality. Assess the quality and track record of the company's management team. Look for experienced leaders who have a proven ability to drive growth and create shareholder value. Evaluate their strategic vision, execution capabilities, and alignment with shareholders' interests. Valuation considerations. While growth is a key criterion, it's important to evaluate the valuation of growth stocks. Consider valuation metrics such as price to earnings, P/E ratio, price to sales, P/S ratio, or other relevant multiples. Compare the company's valuation to its historical averages, industry peers, and growth expectations to assess whether the stock is reasonably priced. Analyst reports and market sentiment. Review analyst reports and market sentiment to gather additional insights on the company's growth potential. Consider consensus estimates, target prices, and analyst recommendations to gauge the market's perception of the company's growth prospects. Risk assessment. Assess the potential risks and uncertainties associated with the company and its industry. Evaluate factors such as competition, regulatory changes, technological disruptions, or other risks that could impact the company's growth trajectory. Consider the company's ability to manage and mitigate these risks. Remember that identifying growth stocks requires thorough research and analysis. It's important to stay updated on industry trends, economic developments, and company-specific news. Additionally, diversification and a long-term investment horizon are crucial when investing in growth stocks, as they can be more volatile compared to other investment types. Consulting with a financial advisor or investment professional can provide additional guidance and help align your investment strategy with your risk tolerance and financial goals.